welcome back to JPX Energy Market Weekly Updates. During the past weeks, rising geopolitical and operational risks are driving prices higher, despite OPEC Plus agreement to raise output by 400,000 barrels per day next month. In Africa, Libya expects to see production fall to 14-month low this week due to internal unrest and field maintenance, which has already tightened market balances. On January 3rd, the state-owned National Oil Corporation said a pipeline that connects the Sama and Dahari fields to 350,000 barrels per day of outside the terminal will be shut for repairs, causing another production fall around 200,000 barrels per day. Kazakhstan, also a non-OPEC producer participating in the output agreement, currently producing 1.6 million barrels per day, has been thrust into turmoil as security forces engage in violent clashes with demonstrators protesting high fuel costs. The country produces around 1.5% of the global oil supply and exports 3.2% of seaborne oil. Oil workers joined protests as January 5th. As a result, Chevron, which operates a 700,000 barrel per day of Tengzi field, indicated disruptions at train lines have started to impact oil production. Two-thirds of Kazakh oil typically heads to Europe, primarily Italy and Central Europe. On Friday, the president of Kazakhstan announced that the constitutional order has been basically restored in all regions of the country, and the local authorities are in control of the situation. On the west of the Atlantic Basin, according to a report from Bloomberg, a deep freeze in Canada and northern U.S. is disrupting oil flows, causing a surge in local crude oil grades prices, just as American crude oil stockpiles are declining last week. In North Dakota's Baking Shale, production has started to succumb to the freeze, and the 590,000 barrel per day Keystone Pipeline, which shipped crude from Alberta to the U.S. Midwest, was also temporarily shut on January 4th, though it has since come back online the following day. So we can see from above, recently not only have production outage worldwide mostly hit some of Europe's main oil suppliers at the same time, but most of these disruptions have also hit light and sweet grades. At the same time, OPEC members have approved another hike in oil production quotas, betting the market can absorb more oil in the coming months despite surging COVID-19 infections worldwide. As a result, the spread between the JPX Dubai and IC Brent remained low during the last 2 weeks, and the Brent and Dubai exchange of futures for swaps was trading around $3.76 per barrel. The hike in production quotas is in line with the roadmap agreed in July last year to gradually unwind the huge production cuts implemented in the early stages of the COVID-19 pandemic. Earlier, the group's Joint Technical Committee revealed an OPEC Secretariat report that played down disruptions from Omicron. The report forecast the effects of variant would be mild and short-lived as the world become better equipped to manage COVID-19 and its related challenges. As a result, the OPEC Secretariat kept its forecast for the global oil demand growth in 2022 unchanged from its previous projection at 2.4 million barrels per day. The Secretariat sees much tighter supply and demand balances for this year compared with its previous projections. In the base case, the Secretariat put the global oil supply surplus at 1.4 million barrels per day in the first quarter, down markedly from the 3.1 million barrels per day oversupply forecast last month. From the perspective of the medium term, concerns of lack of spare capacity rises. Absent a revived nuclear deal that could bring back Iranian oil to the market, sustainable OPEC Plus spare capacity were 400 to 450 million barrels per day in February, which would be exhausted sometime this year if the quarter increases continue. Key producers like Saudi Arabia and top investment banks has warned a potential mismatch between the ongoing energy needs and the oil companies' reluctance to invest, would send oil prices up to 100. Now let's take a look at the new official selling prices. Saudi Aramco cut February official selling price for its Asia-bound crude by a lower than expected level, and the Arab Light was lowered by $1.1 to a $2.2 per barrel premium. The Dubai cash and future spread, which is a key element in the official selling price calculations, averaged $1.5 in December, dipping from an average of $3.4 in November. As we can see from the right-hand picture, JPX Dubai front-month spread also set lower in December, which is a similar indicator. Traders said the lower-than-expected drop would potentially boost demand in the spot market, but capped by interest of China because of less crude import and oil product export quotas could limit trade activities in the East too. We believe the demand from refineries in the East will remain a key focus for the remainder of this year. Okay, that's all for today's video. Welcome back next week.